Your 30s are when life hits all at once. One minute, you're celebrating a solid salary. The next, you're staring at a mortgage application, wondering how adulthood became this expensive. Your bank account gets pulled in every direction: college funds, down payments, retirement savings, and somehow you're expected to stay calm through all of it. Here's what no one really tells you: your 20s are for figuring things out. Your 30s are when you're supposed to have figured them out already. The financial choices you make now can either set you up for comfort or force you to play catch up for decades. My name is Susan, and I help people build wealth without losing their sanity. If you're tired of feeling like your money disappears the moment you earn it, hit subscribe and give this video a thumbs up if it helps you take control. Now, let me be clear. This isn't about guilt. Maybe you're ahead. Maybe you're staring at your bank balance, thinking about switching careers to professional dog walker. Either way, these milestones aren't judgments. They're a roadmap for navigating what can be an overwhelming decade. The first major money milestone in your 30s: eliminate consumer debt. And yes, I mean zero. The only exception is a mortgage if you have one. Everything else needs to go. Credit cards, student loans, car payments, that random furniture loan you forgot about, all of it. I know what you're thinking. Susan, that sounds impossible. My student loans alone could fund a small country. I get it, but here's why eliminating consumer debt matters so much in your 30s. This is your prime earning decade. Your income is likely higher than ever and still rising. The last thing you need is consumer debt acting like financial quicksand, swallowing every raise you get. If you're paying $400 a month on credit cards and $600 on a car loan, that's $1,000 every month, not building your wealth. That's $12,000 a year. Over a decade, $120,000. And that's before factoring in what it could have grown into if invested. And life in your 30s gets complicated fast. Career pressure increases. Maybe you're running a household, raising kids, helping aging parents. Carrying consumer debt through all of that is like juggling flaming torches on a unicycle. Possible? Maybe. Smart? Not really. I felt this personally when my dad started needing more help at home. He's the type who insists on fixing everything himself, which usually means I step in or hire someone. When we had a clogged sink recently, he was determined to handle it with pure optimism and a plunger. It didn't work. If I'd been buried in debt payments, calling a plumber wouldn't have been simple. Financial flexibility matters more than you think. The second milestone: an excellent credit score, and I mean 800 or higher. You might think credit doesn't matter if you're not borrowing, but unless you're paying cash for a house, your score directly impacts what that mortgage costs you. Let's say you're buying a $400,000 home with excellent credit. Maybe you qualify for 6.5%. Over 30 years, that's roughly $511,000 in interest. Painful, but standard. Now imagine your rate is 7% instead, just 0.5% higher. That difference can cost you nearly $50,000 more in interest for the exact same house. And here's the scary part: one late payment over 30 days past due can drop your credit score by up to 180 points and stay on your report for 7 years. Imagine going from a 780 to 600 just because you forgot to pay one bill. That one late payment can cost you tens of thousands in extra mortgage interest. The good news: keeping an excellent credit score isn't complicated. Pay every bill on time. Keep credit utilization under 30%, ideally under 10%. Don't open accounts you don't need, and avoid closing old cards unless the annual fee makes no sense. Length of credit history matters more than people realize. The third milestone is building a clear financial plan for the next 30 years. I know, planning decades ahead sounds exhausting, but your 30s are when multiple financial goals collide. Without a plan, you're just reacting. I like to simplify it. B is for budgeting and saving, knowing exactly how much you need to spend and invest to hit long-term goals. R is for retirement, not just contributing, but checking if you're actually on track. E is for estate planning, especially if you have kids or assets. It's not optional anymore. T is for tax planning, legally keeping more of what you earn. And the final T: tracking your progress, because a plan only works if you monitor it. This might be the stage where hiring a financial planner makes sense, particularly if your income, assets, or family situation are complex. A good advisor helps you see the full picture instead of guessing. The fourth milestone is a bulletproof emergency fund. In your 20s, 3 to 6 months of expenses might have been enough. In your 30s, aim for 6 to 12 months, maybe more if your income is unstable or you're self-employed. Why? Because emergencies get bigger. The water heater fails. Your child needs unexpected dental work. Life gets expensive fast. Your car breaks down, and of course it's something expensive. Your parents need help with medical bills. Or maybe on the positive side, a great investment opportunity appears and you need cash quickly. A strong emergency fund isn't just about protection. It's about options. When you know you can handle surprises, you negotiate at work from strength. You can help family, you can take smart risks, and you sleep better knowing one unexpected bill won't wreck your finances. Keep this invest money somewhere safe but accessible, like a high-yield savings account. Your emergency fund isn't there to make you rich. It's there to protect flexibility. The fifth milestone, have 3 times your annual salary saved for retirement by age 40. If the average 40-year-old earns around $62,000, that means roughly $186,000 invested by 40. And before you panic, here's why it matters. If you start with that amount at 40 and keep contributing consistently, you could grow it to over $2 million by 67. That's compound interest doing the heavy lifting, but only if you give it time. This milestone isn't just about hitting a number. It's about giving your investments decades to grow. Every year you delay serious retirement saving makes the math harder. If you're behind, don't panic. But do get intentional. You still likely have 25 to 30 years. Increase contributions every time you get a raise, change jobs, or receive a bonus. The difference between saving 10% and 15% might feel small today, but over decades, it's massive. The sixth milestone is what I call lifestyle inflation immunity. And this is where you separate real wealth builders from people who just look wealthy. Your 30s are prime time for lifestyle creep. You know exactly what I mean. You get a raise, so you upgrade your apartment. You get a bonus, so now you need a better car. Your income increases, and somehow your expenses rise with it, leaving you no better off than before. I've seen people earning 6 figures who are constantly broke. Expensive cars, high-rent apartments, takeout every night, and still saying they can't save. It's like pouring water into a bucket with holes and wondering why it never fills. The antidote to lifestyle inflation isn't deprivation. It's automation and awareness. Every time your income goes up, automatically send at least half of that increase towards savings and investments before you adjust your lifestyle. Get a $5,000 raise? Increase retirement contributions by $2,500. Your future self benefits, and your current self won't miss money you never saw. The seventh milestone may sound morbid, but it's actually one of the most responsible things you can do: estate planning. If you have kids, a mortgage, or meaningful assets, you need basic documents in place. This isn't about expecting the worst. It's about being prepared for the unexpected. What happens if you're in an accident and can't make decisions? Who takes care of your kids if something happens to you and your spouse? What happens to your home, retirement accounts, life insurance? Without proper documents, those decisions get made by court, not by you. The good news? Basic estate planning is simpler and cheaper than most people think. For many families, an online will and power of attorney is a strong starting point. If your finances or family dynamics are complex, work with an attorney. But having something in place is infinitely better than having nothing. The eighth milestone might surprise you. Invest in your health. Before you tune out, this is financial advice. Your health is your greatest asset. In your 30s, you either strengthen it or start letting it decline. The average American spends over $300,000 on healthcare in their lifetime. Reduce that by even 20% through preventive care, good nutrition, exercise, and avoiding destructive habits. And you've potentially saved $60,000. That doesn't even include missed income from sick days or lost opportunities. And let's be honest, your metabolism in your 30s isn't what it was at 22. Building healthy habits now is much easier than trying to undo decades of damage later. This doesn't mean extreme diets or becoming a fitness influencer. It means consistent movement, mostly nutritious food, proper sleep, and stress management. The money you spend on a gym membership or quality groceries is tiny compared to the cost of preventable health problems. The ninth milestone is planning for your kids' education, if you have or plan to have children. College costs have been rising far faster than inflation for decades. A 4-year degree at a public university can exceed $40,000 per year, including living expenses. Private schools can approach $70,000 annually. You don't necessarily need to fund everything, but starting early lets compound growth work in your favor. A 529 education savings plan is built for this. The money grows tax-free, and withdrawals for qualified education expenses are also tax-free. Over time, that tax advantage can make a significant difference. Many states even offer tax deductions for 529 contributions. It's like getting a small discount on your child's education just for planning ahead. Even if you can only invest $50 or $100 a month, starting early gives that money 15 to 18 years to compound. And under recent rule changes, unused 529 funds can potentially be rolled into a Roth IRA for the beneficiary, giving the money even more long-term flexibility. That means your planning rarely goes to waste. And now, the 10th and final milestone of your 30s, financial confidence. This isn't about hitting a specific net worth number. It's about understanding your financial life well enough that you can make decisions calmly and intentionally, without panic, without guesswork, and without losing sleep every time the stock market dips. Financial confidence means you know your numbers. You have systems in place, you trust your plan, and you're not waking up at 3 a.m. wondering if you're doing enough. This is where a comprehensive financial strategy becomes essential. Your emergency fund, fund, retirement accounts, college savings, insurance coverage, estate documents. They shouldn't exist in isolation. They should work together as one coordinated system. Some people enjoy managing this themselves, tracking spreadsheets, optimizing taxes, adjusting allocations. Others benefit from working with a financial planner who can provide structure and objectivity when emotions try to take over. The key isn't DIY versus advisor. The key is having a plan you understand and believe in, one that evolves as your life changes and keeps you moving forward even when short-term volatility makes it feel like you're standing still. Your 30s are financial prime time. You're likely earning more than ever before. You still have decades for compound growth to work in your favor, but you also have more responsibilities and competing priorities than ever. The decisions you make now will determine whether your 50s and 60s are defined by freedom or financial stress. These 10 milestones aren't meant to overwhelm you. They're not a checklist designed to make you feel behind. They're a roadmap. And the best part about being in your 30s, you still have time. Maybe you didn't start investing at 22. Maybe you made some mistakes in your 20s. That's fine. Regret doesn't build wealth. Action does. Pick 1 or 2 milestones that resonate most right now. Maybe it's eliminating high-interest debt. Maybe it's finally opening that high-yield savings account you've been putting off. Maybe it's increasing your retirement contribution by just 1%. Small, consistent actions compound, just like your investments. And the future version of you will be incredibly grateful that you started today.